I'm Emily Altick. Thank you everyone for joining for today's fall market update. I'm the marketing manager over here at PWM Planning, so I'm going to be guiding us through today's conversation. As we head into the final stretch of the year, here, let me change this slide really quick. Yes. As we head into the final stretch of the year, it's going to be a great time to take stock of where the markets stand and what might be ahead for us. So we're fortunate today to have two experienced voices with us. These two faces might look familiar to you. So we're going to have Certified Financial Planner Andy Rosiska with us from the PWM Planning Office, and then Financial Advisor Ken Stansbury with the CWM Planning Office. These advisors are here with us today to share their perspectives and help us make sense of the current environment. We're going to keep things super straightforward and informative today, so let's get started. So we're going to kick it off with Andy. We are 9 months into the new administration. During our kickoff call that some of you might have joined us on, we talked about several policy changes that could have impacted the markets. Can you give us an update on the status of those changes?
Sure. Thank you, Emily, and welcome everybody. We definitely appreciate you taking the time to join us today. We know your time is valuable, so our hope is to make this, very, very valuable to you. So, but yeah, the administration, I think, as we're all aware, has been incredibly busy. On the positive side of the ledger, we have seen deregulatory type policies put in place. And then we had the one big beautiful bill that got passed, and that covered extension of the tax cuts for both individuals, and then also enhanced some tax law for the corporate side, specifically bringing back 100% bonus depreciation. And so definitely hit on all the positive side. The negative side, they definitely hit there as well. So the rollout of the tariffs, we all felt and saw what happened with that when he busted out the big whiteboard. So clearly, the amount of tariffs that were rolled out and the way it was rolled out created quite a bit of chaos in the market. And so we'll speak a little further on that a little later, but and then we've also been witness to how immigration is being approached. We're seeing that actively now, but I believe we're yet to see kind of the impact of that, and how that's going to impact our economy moving forward. So I think we're going to have to wait a bit to see how that could potentially impact things. But yeah, they've been very busy, and so far, kind of what we thought could be positive, what we thought would be negative, have played out to what we had thought.
Thank you, Andy. Rolling into our next question today. Government shutdowns.
Yeah,
I think you can elaborate a bit more on that.
Sure. So, yeah, especially with everything going on this week, we'd be remiss not to mention this. So, their government shutdowns are more frequent probably than any of us would prefer. We've had 21 of them in the last 50 years, most recent being in 2018, 2019. But what this chart reflects is that, ultimately the market's reaction generally is pretty muted. Performance is basically flat when you average it out during the shutdown period. The average shutdown has been 8 days, the longest being a little over a month. And so I think right now they're projecting, a week to 2 weeks possibly with this particular shutdown. So far this shutdown appears to be kind of in line because the market's reaction has been pretty darn muted. If it does look like this is going to extend out, further, then I think you are going to get a little bit more of a market reaction, and in particular because one of the big drivers of the market is the Fed, and Ken's going to be speaking to this later, but if they're not announcing the data that the Fed needs to make some of their decisions, that little bit of uncertainty could certainly drive a little bit of volatility in the markets.
Great, thank you. Right. So how have these changes impacted GDP growth?
Yeah, thanks, Emily. Yeah, the GDP growth really after a sharp slowdown in the first quarter in which GDP was down 0.6%, growth has bounced back strongly to 3.8% in Q2, which is nearly double the 2024 average of 2.3%. And currently, right now, we're looking at estimates for Q3 being between a modest 1.3 from the Philadelphia Fed survey to 3.1% from the Atlanta Fed's GDP Now model. Of course, that would be published on the 30th, as long as everything gets back in order and we're not still shut down. But that rebound really helped ease immediate recession fears. And kind of diving into some of the numbers, the biggest driver of the second quarter's headline figure was net exports, which contributed 4.8%. Pretty unusual. We don't expect this moving forward, but it was great to see that happen for this quarter or Q2. Inventory drag was significant in Q1 and then it reversed. So the change in private inventory subtracted 3.4% from GDP in Q1, and then in Q2 it was neutral to slightly positive. Really, the big deal though is consumer spending. It makes up about 70% of GDP growth, and it was in line with historical average. It did pick up from Q1, and the consumer remains resilient but cautious. And really, right now, what we're looking at as forward risk is job market weakness, persistent inflation, a consumer slowdown, or a Fed policy shift.
Great. Thank you, Ken. With the economy holding up pretty well, how is the labor market doing?
Yeah, so as Ken mentioned, the big part of the economy is consumer spending, and with consumers getting a little more cautious, a lot of that is because of what's going on in the labor market. We've got this environment. Well, actually, before I even jump into that, um, one of the things that I think has been more prominent over the last year or so has been these major revisions that we've seen within the labor market statistics. And doing a little digging on that, at this point, there's only about 60% of the reporting participants are actually reporting on time. Historically, that number has been significantly higher, and so they've been able to get relatively accurate projections. But more recently, with only 60% of those reporting on time, these projections that they're doing obviously are not coming in line. And so that remaining 40% is really driving these major adjustments that we've seen, months and quarters later. So that's continues to kind of be a challenge that they're going to have to deal with as far as ultimately making a decision about where things are at. But in general, the longer term trend in the labor market, as I said, is definitely softening. So coming out of the pandemic, 2022, we kind of hit a peak where there were 3 job listings out there for each person looking for a job. But as the chart on the right indicates, that number has continued to steadily come down over the last 3 years, and now we're just below that 1-to-1 ratio. So we've dipped into the territory where there's more people looking for jobs than there are job listings. Historically, when we get to this level, one of two things can happen. Things can kind of stay flat for a period, and we see companies start to increase hiring as their comfort level with where the economy is at and their profits as that comfort level gets higher. The flip side, though, is sometimes you do see a relatively steep fall off in the job market after you surpass this, when you get this, when this ratio gets into the negative territory. And so hard to say which path we're going to be on. But I think the next 3 to 6 months is going to be pretty critical as far as what that looks like. We went through this period of major uncertainty where, especially tied to the tariffs, where companies just slam their feet on the brakes as far as hiring or even making big decisions. And so now that kind of uncertainty around the tariffs has somewhat lifted, will kind of remains to be seen as far as what kind of decisions they're going to make as far as continuing to hire and improving the labor market.
Thank you so much, Andy. So we have to talk about inflation. What about inflation?
Yeah. I mean, it's such a big topic for so long. So to me, you know, the big thing with inflation is tariffs, and so kind of revisiting that, we got stuck in this policy loop with tariffs where there'd be an announcement of a tariff and the market would have a big pullback, and then they'd extend, you know, the decision making time, and then they'd come up with a new number, and so it's this repeat and repeat kind of story where, you know, we started to see it over and over again. And eventually the market kind of got used to that and stopped reacting so much to that cycle. I think the big thing there is that, as I mentioned before, the uncertainty around tariffs has come down dramatically. Even though some of them are still being challenged in the courts, ultimately whatever the court decides is not really a factor, because there are other avenues for the executive branch to maintain and keep tariffs in place. So we're kind of settled that, hey, the tariffs are going to be there, and you know, it's not really how they're going to get rolled out at this point. It's just where ultimately are they going to land, and the market's projecting the tariffs end up somewhere between, you know, 17 to 19%. And so how does that impact inflation? I love this chart on the left because it does a good job of telling us that ultimately, you know, the tariff impact on inflation is a temporary scenario. So if unless they increase tariffs a year from now, the projection is that you know, we do have higher inflation for a short period over the next, you know, 12 to 18 months. And then it starts to trend downward back towards what they would consider to be more of the trend inflation line, back towards that 2%. And so I believe that's why the Fed is comfortable going ahead and starting to cut rates, because they're not super concerned about where inflation is at right now. In fact, their favorite measure of inflation, PCE, they're projecting it'll come in, you know, somewhere between 3.1, 3.2% this year, which is higher than their 2% target. But if you strip out kind of the tariff impact, that would have been 2.1%. So at a core level, inflation's doing what it should be doing. And once we get past kind of the tariff impact on inflation, we do believe that that will kind of settle into more of a normal cycle there.
So what does all of this mean for interest rates moving forward?
Yeah, Emily. So, you know, we're likely in the middle of a rate cutting cycle. We do believe that the rates will be cut, you know, gradual, but really will be data dependent based on what Andy was talking about with inflation. If we get a pop-up, we could have a delayed cut. But that's not what we're looking at right now. The Fed fund rate is currently sitting between 4 and 4.25. It's down from its recent peak of around 5.5%. The first rate cut was in September of last year. Last year, we ended up having three in total for 1%. And then we recently had one 0.25% last month. This slide really confirms that both the Fed and the market expect rates to decline gradually from here. We're expecting two more this year and a couple more in 2026, which would get us closer to the Fed's long-run neutral rate of 3%. And again, that's just as long as there's no surprise in inflation or labor data. The Fed is really signaling right now policy flexibility. The markets are listening. And again, inflation, job data remain key. Investors should prepare for a lower but still positive rate environment, which is really supportive for the fixed income.
Okay, thank you, Ken. So we've discussed the broad economy. but what our clients really feel is the resulting market movements. Can you guys take us through the 2025 market environment?
Since it's positive, I'll take this one. Yeah, so well, at least positive now. I think feel is a great way to put it because there's been a lot of feelings this year. Felt pretty awful in March and April. And fortunately, as mentioned before, a lot of that was driven by the uncertainty around tariffs and how they were rolled out. As that level of uncertainty decreased, you saw the market get more and more comfortable. And so, we've recovered fully from that dip and beyond it, setting new all-time highs here over the last few months. And so what's interesting though is that even though we've been at all-time highs, it still doesn't quite feel as good like we are at all-time highs. And so that sentiment can drive things like consumer spending and some of those things. So but ultimately, across the board, everything's in positive territory. Foreign, for the first time in many, many years, is leading the way this year. A lot of that is the weakening of the dollar having an impact. And that's not necessarily something, foreign leading the way is not something we necessarily anticipate, being a long-term trend, but definitely the case this year. Large cap US is up about 13%, small cap US up a little over 9%. And then bonds have finally served the role of being a great risk ballast, especially coming off the 2022 crash where stocks and bonds were taking a hit. It was really nice to see bonds, serve in their role and be that kind of ballast of risk during that downturn in March and April. And they've generated a pretty healthy 3.5% so far this year. And as Ken mentioned, in a falling rate environment, that is supportive of further bond growth. So we anticipate that we're going to get further pretty nice total returns in bonds moving forward over the next year or two as well.
There's some pretty strong returns. What has that done to stock market valuations?
Yeah, Emily, it's definitely pushed them up. Just so I kind of go over the PE ratio, and for those that are not familiar with it, it's a ratio that measures how much an investor is willing to pay for a dollar's worth of annual earnings. The S&P 500 right now, the forward PE ratio is around 22.6, which is well above the 30-year average of 17. However, when we look at the 5-year average, it's a little bit closer. We're at 20.9. The valuations are historically elevated, reflecting strong earnings expectations, but also potential risk if growth does disappoint. The last time valuations were this stretched, subsequent market returns were more muted. However, a lot of folks have talked about the 90s with the tech bubble. However, we don't see that. Valuations are supported by strong corporate profitability and secular growth drivers. Artificial intelligence, technology, healthcare innovation are among those drivers. However, elevated valuations don't mean an immediate downturn, but they do raise the risk of volatility if earnings or economic growth slows down. So with the market price for perfection, earnings delivery becomes critical. And don't fear an expensive market if earnings are driving it. So right now, for 2025, S&P 500 earnings per share are forecast to grow by about 10.1%, which is well above the long-term average of 7.3%. And the growth is primarily driven by the expanding profit margin, which is at 6.3%, and steady revenue growth. In Q2, the S&P profit margins reached a record high of 13.6%. The elevated margin level signals that companies are maintaining a robust profitability despite some macroeconomic headwinds. So strong margin expansion, double-digit earnings growth for 2025 remain tailwinds. Again, that's a positive thing for the S&P 500. And analysts are expecting continued earnings growth into 2026 and to 2027. And then really, while overall market valuations are still elevated, especially for growth, Solid fundamentals, strong earnings trends really could help provide support even amid choppier macroeconomic conditions. And then we'll talk a little bit. I get this question often about value versus growth. And it is true. You look on the left-hand side of this chart, late September, the Russell 1000 Value Index was trading at a 45% discount to the growth index on a forward PE basis. The long-term average discount is 30%, which is really implying that value stocks are even cheaper relative to growth than usual. However, when you look at the chart on the right-hand side, the top right, you see that earnings year-over-year growth for growth companies outpace value stocks by a good bit. And you could see in 2024, value companies grew their earnings by 2%, while growth companies grew at 18%. So again, we believe that still justifies these higher PE ratios because they are growing at a much faster pace. And as I mentioned earlier, don't fear an expensive market as long as the earnings are driving it.
Great. Thank you, Ken. So that's certainly some positive news on earnings. What can we expect moving forward?
I mean, the one thing that is highly likely that we can all expect that's not really going out on much of a branch to say is that, or limb, not a branch, is to expect volatility. And this chart is the perfect example of that because even during positive years, you see the red dots at the bottom. That's a drawdown that occurs during the positive years. And if you averaged out all those red dot numbers, it ends up being about 10%. So even during positive years, you have volatility and you have the market take a 5 to 10% pullback. Certainly, we saw more than that in the spring. But because we've had such a quick recovery off the bottom, as I mentioned before, it would not shock us to see, one of those 5 to 10% pullbacks prior to the end of the year. And whether that's, the shutdown lasting longer than what's expected or, a surprise in some of the data once they do start releasing it after the shutdowns, any number of things could be the driver. But just know it's also, there's going to be something that creates this kind of healthy pullback before what we believe is going to be the next move forward and ahead with the market to more all-time highs beyond that. And so, I think that was it on that one. So then, thank you, Emily. Sorry, I forgot what was next.
You're good.
So in these two slides, we actually showed at the beginning of the year as well, but there's also some historical trends that lend themselves to there being some potential further upside. So this one's showing historically after the S&P has 2 years of 20+% positive returns, what happens after that? The average has been 12.3%, which, as I mentioned before, we're slightly above that for 2025 so far. So we think there's a really good shot we end up, where we're at or possibly a little bit higher. And history would show that there's a good case for that to be made as well. And then the next slide shows what the stock market has done after the Fed's first rate cut. And so if we look at the average numbers there, 12 months later is the benchmark we're at now. We're 1 year in. The market's up close to 17% during that time frame. The average has been 7.2%. But right below that, the average when there hasn't been a recession has been 19.6%. So we're in line with that so far. And then looking further to the right, the 3 year later number, 41% on average, 70% if we don't go into a recession, and then 77% for 5 years and over 100% with no recession. So again, not guaranteeing that history repeats itself, but there is definitely a track record there if we can avoid recession, which I think is is pretty likely that there's still quite a bit of runway left for this market and positive returns moving forward. So then, how does that play into, what we're doing from the portfolio side? Well, we are right now we're looking at absolutely no changes on the risk side. So we're not dialing risk up or dialing risk back. As Ken mentioned, we do still favor growth. And a lot of that is based on what we believe to be the primary driver of the economy moving forward, which is AI and AI implementation. At this point, only 9.4% of American companies have implemented AI in a meaningful way. And the early adopters, we are starting to see some of the benefits of that with increased profitability. And so we do think that we're early in the AI kind of phase of this economy, and so the runway for growth especially is significant. But we do believe AI can be implemented across all sectors, and so growth and value stock should benefit, but we still think growth will reap more of that reward. We are looking into, on the equity side, a call premium income strategy. It's kind of in our due diligence periods. We're not ready to kind of talk about it in full just yet. But if that is something that we end up liking once we're done with due diligence and it gets through committee, you'll definitely hear from us on that if it makes sense for your portfolio. And then on the non-stock side of the portfolio, we're going to maintain our neutral interest rate sensitivity. So where we're at with interest rates, we feel like we're well positioned to take advantage as rates do continue to fall, and capture more total return versus just the interest being paid out on the bond part of the portfolio. And then again, we're exploring another kind of higher income producing asset class that we don't have a lot of exposure to on the non-stock side of the portfolio. And hoping here in the next couple of weeks we'll have a decision of whether that's going to end up being part of the portfolio or not. And again, you'll hear from us if we decide to implement it. So then the key takeaways for today's calls. You may recognize this if you've been on calls before, and I don't anticipate this slide really changing much over time, because that our vision is that the whole idea is to stay disciplined. So keep the long-term view and do the best that we can to kind of to cut out the noise, because unfortunately the way that things are set up, there's a lot of financial motivation to put articles out and have shows talking about things on the extreme. So either it's going to be really great for this reason, or it's going to be really awful and we're going into a depression for this reason. And reality has been that it's typically somewhere in the middle. And so that's one of the reasons we have the job we do is our ability to strip all of that out and make decisions based on what's actually going on. And so we'll continue to do that for you, but we do recommend turning off the news because that it's just not good for your blood pressure ultimately. And then again, nobody can actually predict what's going to happen in the market, and so our job is to make sure that you and your portfolio are prepared for multiple scenarios within the market. And we feel like we're in a great spot with that right now, to A, protect if we get some volatility, but also B, continue to capture the great upside that we've seen over the last 2 to 3 years. And finally, the big thing is we just want to continue to touch base with you on your risk preference, make sure that we are in line with that, and then make sure that we're getting updates on your goals and that everything that we're doing is aligning with your goals and pushing towards you and your family accomplishing what you ultimately want to accomplish, and you being able to sleep at night and just focus on what is important to you. So that's our goal and always has been, and we hope to continue to be able to deliver that for you.
Thank you, Andy. Thank you, Ken. And thank you, everyone here, for joining us today. We hope that this update provided some helpful context as you continue to think about the months ahead. If you guys do have any follow-up questions or want to continue the conversation, we're always here, so don't hesitate to reach out to us. I have our contact information here. As far as social media goes, we're on everything: LinkedIn, Facebook, Instagram, YouTube, if you prefer to keep in touch that way. We are wishing you a great rest of your day, and we look forward to connecting with you guys again soon. But take care and have a good rest of your week and a great weekend.
You guys really
Thank you.
appreciate it.